Welcome to The Explainer. Look, if you've been anywhere near the financial news lately, you've definitely heard the breathless coverage surrounding the upcoming SpaceX IPO. The TV pundits are completely fixated on the debut stock price, the sheer spectacle of the valuation, and, the inevitable speculation about whether the stock is going to shoot straight to the moon by next Thursday. But as a careful investor, you know that excitement is the enemy of solid analysis. So today, we're going to set aside the noise, step away from the barbecue chatter, and adopt the objective, clear-eyed perspective of a professional financial advisor. We are going to look strictly at the mechanics, the legal filings, and the structural market forces at play. Because I promise you, beneath those $2 trillion headlines lies a much more complex and, frankly, much more fascinating reality.
Okay, let's dive right in. Here's a number that absolutely stopped me cold when I first read it. Not the valuation, not the speculative stock price. This specific number was buried on page 11 of the actual legal document filed with the SEC. $28.5 trillion. That is the size of the market this company told the U.S. government it intends to go after. In their own words, they called it the largest actionable total addressable market in human history. It's larger than the entire U.S. economy. And nearly every piece of financial commentary I've seen since that filing dropped has been focused on entirely the wrong thing. So, let's be useful here and structure our analysis around what actually matters.
Here is our roadmap for today. 1. The $28.5 trillion market. 2. Beyond rockets. 3. The AI economy in space. 4. IPOs supply and demand. 5. Founder and valuation risks. And 6. Long-term strategy.
Section 1. The $28.5 trillion market. Unpacking the scale.
Now, obviously nobody captures an entire addressable market, right? But let's do some quick math that should make any cautious investor pause. If they capture just 10% of that total figure, that equates to approximately $3 trillion in annual revenue. To put that into perspective for a second, the entire S&P 500 index today, literally every major American public company combined, generates around $18 trillion in revenue. Capturing just 10% gets you to 1/6 of everything produced by the S&P 500 from one single company. That's exactly why the real question here is where the ceiling actually is.
Section 2. Beyond rockets, the true business model. When most people hear this company is going public, they instantly picture those fiery, beautiful rockets landing themselves on floating platforms. But when you read the SEC filing carefully, you find a business model structured in 3 distinct ascending layers. Step 1 is the rockets and launches. They project roughly $370 billion of addressable market there, which is a highly meaningful business, sure, but it's actually the smallest of the 3 layers by a very wide margin. Step 2 is Starlink connectivity, providing broadband and internet from low Earth orbit and entirely bypassing traditional ground infrastructure. And Step 3, the absolute largest layer with a massive $26 trillion potential, is building space-based AI data centers.
And this brilliantly illustrates why that first layer, the rocket business, is so dominant. Think of it this way. Imagine if, every single time you flew from New York to Chicago, the airline blew up the plane right after it landed. Every single flight required a brand new plane. That is exactly what the rocket industry looked like before this company came along and figured out how to land, refuel, and fly the same vehicle again. It changed the math so dramatically that it basically made every other launch provider on Earth fundamentally uncompetitive. That is a real, incredibly durable economic moat.
But as miraculous as those reusable rockets are, the current revenue breakdown tells a totally different story. Right now, 61% of their revenue actually comes from Starlink, not rockets. Starlink has skyrocketed from 2 million to 10 million subscribers in less than 3 years. Instead of spending hundreds of billions of dollars doing things the old way, like burying fiber optic cables or erecting cell towers, this service goes over the top. Literally. They have a fundamentally lower cost structure to deliver high-speed internet to anyone, anywhere on the globe, and they're already the primary revenue engine for the entire enterprise.
Section 3. The AI economy in space. The $26 trillion ceiling.
Now, this is the layer that has Wall Street completely scratching its head, but it is absolutely crucial to understand. Running artificial intelligence data centers on Earth involves 2 major existential costs. First, massive amounts of electricity to power the computer chips, and second, massive cooling systems to keep those chips from literally melting. But in space, you solve both problems simultaneously. You have permanent solar exposure providing free electricity 24 hours a day with 0 weather interruptions. And the ambient temperature of space is roughly minus 270 degrees Celsius. That is free, infinite cooling on a scale you simply cannot engineer on Earth for any price. Because they're the only entity capable of getting large, heavy equipment into orbit affordably,
They are positioning themselves to be the computational utility backbone for the global AI economy over the next 50 years.
Section 4, IPO supply and demand, mechanical market forces.
A lot of IPOs follow a super familiar pattern, right? Early insiders sell their shares once public, the market floods with supply, and the retail investors who bought into the hype get crushed. But this situation has a totally different structural setup. If you've held shares in this company for 20 years, selling them triggers a massive capital gains tax event. It could potentially eat up to 33% of your money. Wealthy insiders do not volunteer to pay that. Instead, they'll just go to a major bank and borrow against their shares at perhaps a 4% interest rate. The shares stay put, zero taxes paid, and the supply of public stock remains incredibly tiny. Meanwhile, colliding directly with this tiny supply is an enormous wave of forced algorithmic demand.
So let's see how this builds into a totally explosive scenario. The NASDAQ actually quietly revised their criteria for index inclusion recently. New public companies used to wait 3 months to be added to the NASDAQ 100 index. Now that wait is just 15 days. They also added a highly specific rule. If your public float, meaning the shares actually available to trade, is below 20% of total shares, your index weighting gets multiplied by 3. There are trillions of dollars sitting in passive index funds right now. When a stock is added to the index, those funds are legally obligated to buy it. They literally have no discretion. Picture a scenario where there are only 10 glasses of lemonade available for sale on the hottest day of the summer, and suddenly 1,000 people show up who are contractually obligated to buy a glass, completely regardless of the price. That is exactly what happens when hundreds of billions in automatic, rule-driven index buying collides with the tiny supply of available IPO shares. The price of that lemonade doesn't stay where it started. That isn't speculation. That is just mechanical arithmetic.
Section 5, Founder and Valuation Risks. The sober reality check.
So, as a professional financial advisor would ask, what are the real structural risks hiding beneath a $2 trillion debut? We have to look past the compelling story and assess the vulnerabilities that could genuinely hurt an investor.
Impartially speaking, the absolute largest risk is actually the company's greatest asset, the founder. We're looking at a founder concentration of 85% voting power. This individual runs multiple companies and generates a fairly consistent clip of political and public disagreement. This creates a singular point of failure, unlike anything you'd see in a typical large public company. If health, politics, or distraction disrupts his involvement, the business doesn't just run on autopilot. The personality and the company are not yet separable. Furthermore, there's the risk of valuation patience. A $2 trillion entry price requires flawless execution. If an AI setback occurs, or a rocket launch fails publicly, or subscriber growth slows down, a stock priced for absolute perfection is going to face a severe correction.
However, we also have to look at the alignment facts. It's only fair. The CEO has legally bound himself to a 366-day lockup period. Most insiders are restricted for 180 days, but he took a full year plus 1 day. Even more importantly, the SEC filings detailed legally binding performance milestones. He actually doesn't receive the majority of his compensation unless the company reaches a $7.5 trillion market capitalization. The man running the company has voluntarily signed a federal contract stating he doesn't get fully paid unless he delivers a 4 to 5 times increase from the starting valuation. That is an incredibly powerful alignment of management's financial interests with shareholder outcomes.
Section 6, Long-Term Strategy. Navigating the noise.
Look, you should never, ever buy a stock just because a TV pundit or your neighbor told you to. Those are basically just invitations to be someone else's exit liquidity. A genuine emotionally detached investment thesis actually sounds a little more like this. It's grounded in the belief of global adoption, structural cost advantages, and most importantly, a willingness to hold the investment for 5 to 7 years through the inevitable, frankly terrifying volatility that always comes with an early-stage growth story of this magnitude.
And here is the slightly boring but historically highly effective advice. Let the market mechanics do the heavy lifting for you. If you aren't a professional investor prepared to stomach massive discomfort, simply holding a NASDAQ index fund is your absolute best friend here. Because of the inclusion rules we talked about earlier, those funds will automatically buy the stock for you. You don't need to try and guess the IPO opening price. You just hold the index, letting the forced buying rules work to your advantage, which gives you automatic exposure to the company's long-term growth.
I want to leave you with this final provocative thought. The distance between an aspiration of a $28.5 trillion market and reality? Well, that's where investing actually happens. The question isn't whether this is a great company, it's whether you understand it well enough to hold it through the corrections and the brutal news cycles.
A great company bought at an excessive price is just a mediocre investment. Price matters. So, do you understand it well enough to hold it through the noise? Because if you don't, that is perfectly fine. It just means you need to keep reading before you commit your hard-earned money. The best investment you will ever make is the one you thoroughly understood before you made it.